tested. So chapter 3, if you look at your course outline, what are we talking about there, my good friends? The next one are the methods of interpretation of the regression. Yeah, already have done the interpretation. We have done interpretation of regressions. I don't know whether Liz, you are there. So we have here chapter 3, learning and decision-making techniques. Of which we start with the first planning tool, what we call the cost volume profit analysis. Cost volume profit analysis, CVP analysis. CVP analysis. I'm so lucky because most of you did your management accounting last semester. I will not make assumptions of knowledge, but I mean, that also helps a bit. That helps a bit. Yeah. So CVP analysis. So under CVP analysis, first of all, what are we supposed to appreciate under CVP cost volume profit? What you're supposed to appreciate here is this. What you're supposed to appreciate is this, that CVP analysis, CVP analysis, studies the relationship, between full colon, number 1, costs. Yeah. Number 2, sales volume. Number 3, profit analysis. We shall be looking at the relationship between costs and volumes, between sales volume and profit, costs and profit. So anytime we are talking about cost, volume, profit analysis, we are looking at a relationship between these 4 factors. So it helps the management determine. We're writing there. It helps the management determine. So it helps management determine. Very important. Number 1, break-even point. If you remember very well, this is the point of zero profit. Point of zero profit stroke zero loss. No profits, no losses. Yeah. Number 2, this CVP will help us to determine the required sales for a target profit. I hope you are writing as I write. Number 3, it will help us determine what we call margin of safety. Margin of safety. It will help us to determine what we call the margin of what here? Margin of safety, like that. Margin of safety, like that. Now, ladies and gentlemen, we shall start with the first one here, which is break-even analysis. So we shall come here and look at, we are writing there, break-even analysis. And then we go to the past papers, right? Break-even analysis. So this determines the sales level where total revenue equals total cost. It determines the sales level where total revenue equals total cost. Now, my very good students, please tell me, is there somebody who could be knowing the formula for getting profit? You see this pie for us, the pie for us will be standing for profit. Whenever you see pi, don't think about 22/7. Whenever you see pi, don't think about 3.14. Whenever you see pi for us is the profit. How do we get this profit? It is total revenue minus total cost. Total revenue minus total cost. So then if we look at a point where total revenue equals total cost, as in you generate 5 shillings and you incur 5 shillings, and you're supposed to be subtracting total revenue minus total cost, then you're learning something very important. That at break-even point, profit is always equal to 0. Once you understand this, ladies and gentlemen, then you have understood most of the things that I would want us to do today. At break-even point, profit equals 0. At break-even point, profit equals 0. Thank you so much, Pauline. You're doing a very, very good job. Thank you so much, Jane, Edwin, nilifanya kitambo. Don't worry, I'll be able to take care of you. You can see where I've begun from. Too basic, where at break-even point, profit equals 0. And why is it 0? Because at break-even point, total revenue always equals total cost. But ladies and gentlemen, remember that break-even point is still a point of happiness. Like I remember when we started the RCM, when we used to have like 10 students, 30 students the whole semester. I mean, that time, our expenses were way higher than the revenue we're generating. We continued like that until we hit like 1,000 students where we were able to break even very well. So yes, we are not making any profits, but you see the fact that we can easily finance all our costs from internally generated revenues is a big, big plus for us. Because you see most businesses shut down because they're not able to reach break even. Before you reach break even, it means you're borrowing from outside there, you're getting money from relatives in this case to run your business. At the break even point, you'll be very happy because all the costs incurred by the company are financed 100% through the total revenue we collect from our customers like that. So still, it's a point of happiness. I'm not making any profits, but I'm happy because I'm not struggling. Ladies and gentlemen, remember, struggling life is not a very, very good life. And that is why there are people who normally come to me asking, in this case here, for advice. Whenever I get like now this coming for advice, yeah. So for example, people are seeing that things are not working out. As I started this class, I told you, ladies and gentlemen, this one here, please forgive anybody. Whenever you see somebody who is below 32 years, around this, most of this, it's only one maybe out of 1,000 who will be doing very well, who will be breaking even. But most of these guys are really struggling. But trust you me, by the time they hit 35, by the time they hit 40, these guys here will be very, very comfortable. Very, very comfortable. Because, ladies and gentlemen, in most cases, or unless this person is another one, in most cases, wealth is directly proportional to age. Directly proportional to age. Even myself, I remember, yeah, I mean, below, very few, like me, I was an outlier. Me, I was able to do a lot of things at about 27. I was an outlier. Yeah, but most people really struggle at this before they reach here. All right. So at the break-even point, ladies and gentlemen, the revenue I get will be able to satisfy the costs of my family. Sharp boys and sharp girls. Wako below 27, like Christine, I'm not able to understand that very well. You'll elaborate on this later. But now, ladies and gentlemen, we are saying at the break-even point. Break-even point is a good point. Trust you me, over 80% of businesses that start in Kenya here, they collapse before they celebrate their second birthday because they're not able to break even. They are not able to break even. Tajia amesema mwalimu, hiyo tuwachana hiyo story, hawezi elewa. Okay, hawezi elewa. Oh, Coleman and Coleman. I'm not in that class. Trust you me, I work very hard. Like today, I woke up at 5. I've been teaching. I've been teaching throughout. The only work that I can do very well is to teach. Most of those other jobs, including coding, I don't think I can manage. I just like teaching. Yeah. And if you like your job very well, then automatically you will be able to get something out of whatever you're doing. Now we go back, ladies and gentlemen, to this formula. Now, I saw some lady there telling me that Mwalimu, we know the formula of getting profit. And this formula, I would want you to highlight it. That to get profit, we normally take total contributions minus fixed cost. Are you able to write this formula in a way and then get to highlight it very well? Please highlight this formula. Write this formula and highlight it. I know you have highlighters. If you are a UDA person, use yellow. Yeah, please. I know you can highlight this. Oh, I love braiding. Wow. Okay. Okay. So I simply want you below here to write profit equals CMX minus fixed cost, where this CM is contribution margin. This CM is contribution margin. Is contribution margin. Profit equals CMX minus F. Minus F. So CM is contribution margin. I'll explain that. And to get contribution margin, we normally take selling price minus variable costs. Anytime they want us to get contribution margin, we take selling price minus variable cost. Of course, X is quantity demanded. Quantity demanded. F is the firm's what year fixed cost, like that. And that is why I would want you, ladies and gentlemen, to always think about my profit being equal to P minus V. If you go and get this kind of a formula, P minus V minus fixed cost, this is a formula that you should be able to also understand very well. Because you see P minus V is what here is contribution margin. Is contribution margin. Now, my very good students, please listen. Listen, but before I continue, have you been able to write up to here? Have you been able to write up to here? Thank you so much. Thank you so much. So we continue here. You are the gentlemen and ladies, in this case here, who are the sharp boys and sharp girls. Yeah, you just told me here that my profit, is what you told me, that profit equals CMX minus fixed cost. And you're telling me that at break-even point, profit equals 0. Profit equals 0. So I want us to get the break-even point quantity. So please make X the subject of the formula. The subject of the formula. Please make X the subject of the formula. I move up, okay? Here. Jennifer, there. Jennifer, okay, you're okay. All right, sorry, I think I moved a bit fast. I agree. Because I want to do one past paper question before we disappear. I want to do one past paper question. So make X the subject of the formula. We are saying that break-even point profit is 0. So 0 will be equal to CMX minus fixed cost. Because we're looking for break-even point. So make X the subject of the formula. If I make X the subject of the formula, I will bring this to the other side. So here it's positive, on the other side it will be minus. So minus CMX equals minus F. So minus and minus will cancel out, giving me X of F over CM. This is something that I would really, really wish that you guys will remember forever. Very important stuff, this one. Very, very, very important stuff we have there. Very important stuff. This one here, very important stuff that we have there. Now, ladies and gentlemen, please listen. Nobody will ever tell you at this level to derive a formula. It is us who will be expected to always remember that X break even, please BE stands for break even. X break even equals fixed cost over what we call CM. X break even will be equal to fixed cost over CM. So this is really important. And they will give you a small exercise. They will tell you if fixed cost is 1 million. Yeah, price is 10. Variable cost is 6. Will be required to determine quantity to break even. Are you able to give me this answer? Determine quantity to break even. Determine quantity to break even. And then you should be able to get time for you to teach me the story of sharp boys and sharp girls. I like sharp boys and sharp girls. 250,000. You can see what they've been able to do. You can see what they've been able to do pretty fast. What these ninjas have been able to do, ladies and gentlemen, is this very easy. This is what they've been able to do. Solution. So first of all, they have gotten CM, and the CM is P minus V. Selling price here is 10 minus variable cost of 6, which will give me what there, which will give me 4. And then they went ahead to remember the formula. They remembered the formula. They came here and remembered the formula. Mwalimu, what do they want? They want us to give them quantity, which is X, to do what? To break even. And to get this quantity to break even, I will take fixed cost of what here over CM, sorry. Fixed cost over CM, and the fixed cost of the farm is 1 million divided by CM, which is 4, like that. That is what they did for them to get 250,000 units. If they want to break even, they must sell goods worth 250,000. Very important. So this is exercise number 1. And with the permission, before I go to the past papers, with your permission, no, I will first of all give you like a minute for you to write up to wherever I am. I want to go to the past paper. We clear the session before our time because I appreciate that now students have AFM after this. Myself after this, I'm going to teach a subject known as AI for accountants and auditors. Oh, Valerie, thank you. Wow, great. Thank you so much. So then question number two, now they have given you fixed cost is 1 million. All right. They have given you price is still 10. Crazy people that are repeating questions. But now they'll come here and tell you required, determine the quantity to be sold. Quantity to be sold by the farm in order to earn a profit of Kenya shillings 800,000. Let me give you 1 minute. You try this. Simple question. Now they're not talking about break-even point. Now they're talking about some targeted profit. Let me give you a minute. They're saying 450,000. Kate Onyango, Sharon A. Abdallah, 2 students who are seated in different counties. I believe they cannot cheat us. They can't conspire to give us. You can see Zippy, Kerusi, Galia. Zippy, you're coming from Rwanda. Are you coming from Rwanda, Zippy? Oh, wow, great. So then these students have been able to know, Mwalimu, this one here, to be able to get X for a targeted profit. X for a targeted profit. We take the fixed cost you want to pay, all the fixed expenses. You add the profit you're targeting, divided by CM. So anytime we have X for a targeted profit, it's fixed cost plus the profit all over CM. The fixed cost that we have here is 1 million Kenya shillings. The profit we are targeting is 800,000 Kenya shillings. The CM will not change. The CM will still be what they are for, like that. The CM will still be 4. Because to get CM, we take price minus variable cost. The selling price is 10, variable cost is 6. Will this, my very good students, end up giving us 450,000 units? 450,000 units? Thank you so much. 450,000 units. Thank you so much. That is really, really great. Really, really great. Now, ladies and gentlemen, I would want to go to the next exercise, which is exercise 3. Now, these ninjas are giving you again, they're still on your back, still on your back. Fixed cost is 1 million. Price is 10. They're giving you variable cost of 6. But now, in the required, they don't want quantity. They want revenue to break even. They want revenue to break even. They don't want quantity. They don't want X. They want revenue to break even. Can you kindly, in this case here, assist Mwalimu here? How do we get this revenue to break even? Mwalimu, I know this. Mwalimu, this I can do very well. Without even your interventions, Mwalimu, this I can get it. Why? Because, Mwalimu, I can come here and get, first of all, X break even. Remember, X break even F, we are targeting 0 profit. So don't say F plus profit over CM. So the fixed cost, Mwalimu, here is 1 million. The CM here, it is price minus variable cost. It is 10 minus 6. All right? Which will be 1 million divided by 4. Which you guys were able to comfortably give me 250,000. That's what you gave me earlier on, if you remember very well. But now the question is, how will I change this quantity to money? How will I change this quantity to money? To change this quantity to money, you and I, we are accountants, and bright accountants for that matter. We know, my very good students, that anytime they want me to get revenue, I'll always take price times what here? Quantity. And the selling price is given here. The selling price is 10 here. So this is 10 times the quantity to break even, which is 250,000. That is why you saw some students there getting 2.5 million Kenya what here? Kenya shillings, like that. So anytime they want me to give them revenue, revenue is price times quantity. So first of all, get quantity to break even and then monetize it. How do we monetize it? We take price times quantity. We take price times quantity. Method number 2. Method number 2. Method number 2. But first of all, before I go to method number 2, have you guys been able to write up to here? Feedback, please. Thank you so much. Method number 2. So then method number 2, this is what we have here for method number 2. It's called the CMR, method. CMR method. Where CMR is contribution, margin, ratio. Contribution, margin, ratio. And my role tonight is to simply show you how we get CMR. Get contribution margin ratio, we take the contribution margin and divided by the selling price. Anytime they want us to get the contribution margin ratio, we shall take CM over what here? Over price. this very question that we have done, are you guys able to remember our CM? What was our contribution margin, if you don't mind? What was our contribution margin? The one that we have done up there. Margaret, thank you so much. It's 4, and the price is 10, which will end up giving us what here? 0.4, which will end up giving us 0.4 like that. Now, once I've gotten this contribution margin ratio, to get revenue break even, now I can do this directly. I will take the fixed costs all over the CMR. You take fixed costs all over CMR. Fixed costs all over CMR. Where our fixed cost, if you remember very well, the fixed cost was 1 million. CMR is 0.4, like that. CMR is 0.4. Is there somebody who is able to confirm that Mwalimu, this one is giving us the same answer like the one we got above? 2.5 million is the answer. Thank you so much. Kenya shilling. It's called CMR method. There is no method which is superior than the other. We have to understand all of them, because in some questions, as we're going to see from the past papers, you'll get yourself with units, break-even units. How do you go back to getting revenue break-even using the bigger formula? No. Once I have the units, if they tell me to give them revenue break-even, I monetize those units. Revenue equals price times quantity. Now, ladies and gentlemen, it doesn't stop there. We go to another exercise, which is exercise number 4, and I'm so sure you are tired. After this exercise, I won't even go to the past paper. After this exercise, we shall simply break. So exercise number 4, number 5, I don't know. So we have our product here. Product A, B. They have given us prices, 10, 8. They have given us variable cost per unit. Yeah, 6, 2. They have given me what we call the sales mix. Yeah, 0.4, 0.6. 0.4 and 0.6 like that. All right. And then we are given fixed cost of the farm. Fixed cost of the farm. Fixed cost of the farm is 1 million, the whole farm which is making those two products. So we are required, ladies and gentlemen, to determine break even quantity. That's number 1. And then number 2, determine break even sales revenue. We finish this, go home. We go home. They want us to determine the break-even quantity, and then number 2, we determine the break-even sales revenue. I want to know whether you guys have been able to write this question up to here. Nobody should be left behind. So step number 1, once you get this kind of a question, step number 1, please give us contribution margin for each product. Contribution margin for each product, what do we have there? Remember, it's price minus variable cost. Like now here, A, it will be 10 minus 6. So 10 minus 6, yeah, which will give me what figure? 4. B, it will be 8 minus 2. 8 minus 2, which will give me 6. Now, once you reach there, ladies and gentlemen, how I wish I had a bigger space. How do I create? I must be a genius to create this extra space. Unfortunately, I am a genius. I mean, I can come and take yeah, great. So we have here our sales mix, 0.4, 0.4. And then I have contribution margin. You guys have been able to give me as 4 and 6. Now, I want you, great students of mine, to do me a favor. Like you will see most of the questions in your past paper. This is the criteria. They follow all of them 4, 6 here. 4, 6 years. All of them, this is the criteria, they follow all of them. I know you guys have space there. So I want you to come here and give me the weighted CM. Please give me the weighted CM. That is CM with weight. You know what I will take here as my weight. I want to see whether these guys are following. Do you know what I will take here as my weight? Do you know what I will take as my weight? Thank you so much, Kungalo. So the weights will be this sales mix. Sales mix will be my weight. These ones here. This will be my weight. Thank you so much. And somebody already told me, Mwalimu for A, take 0.4 times 4. 0.4 times 4, which gave you guys 1.6. And then 0.6 times 6. 0.6, which is 3.6. So giving me what we normally call WACM. So WACM, you take this plus this. This plus this, which will give me what figure? WACM. I'll tell you what WACM stands for. I'll tell you what WACM stands for. So 1.6 plus 3.6. What am I able to get here? Most of them are telling me 5.2. Now, I want you to do me the last favor. Only the last favor. Please give me the weighted price. The weighted price. This is really important for me. Weighted price. Weighted price means you take the weights times the selling price. You take the weights times the selling price. I can even write here, like now this will be 10 times weight of 0.4. You can see the weight here. So the first one, I'm being told it gives me what figure? The first one will give us what figure? If you're following, of course I know the answer, but I want us to walk this journey together. AMA journey together. So this is 4, pardon, okay, 4. And then weighted price for B, it will be 8 times 0.6, which gives me 4.8. Thank you so much, Jane. So then can you kindly give me what we call the WAP? WAP will be 8.8. So remember, what have I done? This question up to sales mix was given. We have the weights here. What I did was basically to get the contribution, what here? Contribution margin. How do we get this contribution margin? It is price minus variable. 10 minus 6, 4. 8 minus 2, 6, like that. And then we came and attached weights to this CM. We got what we call weighted contribution margin, which will be the weight itself times this. 0.4 times 4 gave us 1.6. 0.6 times 6 gave us 3.6. Now, please, ladies and gentlemen, we do number 1, solution to number 1. Number 1, they want us to give them X break even. But now remember, now we have what we call multiple products. 2 of them to be precise. Multiple products, 2 of them to be precise. If it is a single product, I would have said X break even is F over CM when it's single product. But when they are multiple, we bring this thing of WACM like that. So anytime it's multiple, we say it's fixed cost over WACM, where WACM is weighted average contribution, weighted average contribution margin. Thank you so much, Jane. That's really good. So weighted average contribution margin. So fortunately, we have our fixed cost. Our fixed cost is 1 million for the whole farm. Divided by WACM, you give me a figure of 5.2 if I'm not wrong. So is there somebody who is able to give me this X break even before we break? I want us to break now. 1 million. I hope it's a beautiful number. I pray it is a beautiful number. I pray it is a beautiful number. I pray it is a beautiful. No, it's not beautiful. Oh, yeah. They're telling me that, Mwalimu, you know what? They're telling me, Mwalimu, you know what? That our X break even is 19,230, 19,230.70. Is that okay, really? Is this answer correct? 1923, 192, 307. 192, 307, 192, 307.70. Thank you so much. Remember, these are units. Can I ask you a question? You see, this X break-even is for multiple products. I want to subdivide it into the individual products. Which criteria do you think will I use to subdivide it? Which criteria do you think will I use to subdivide it? I want to subdivide this. The sales mix, Dina. I can assure you, Dina, you are such a good student. You are such a good student. So in this case, your breakdowns, not breakdowns, breakdown. A, we know the sales mix of A. It is 0.4. So it will be A is 0.4 times 192, 307.7. Are you able to give me this answer for A? A is 40%. A is 40%. A is 40%. Oh yeah, they don't want us to break now. Oh yeah, they don't want us to break now. Oh yeah, oh yeah, they don't want us to break now without giving me a figure. So we have Jen giving me 76, 923, 976, 923.08 units. How about boy? I know boy is 0.6 or 60% of 192, 307.7. Yeah. So B, I'm being given by Carol Simiu 115. OE 115, 384.62, like that units. Thank you so much. So I've been able to answer number one, where they wanted us to give them the break-even what year? Break-even quantity. That we have done. And then number two, now they want me to convert this to break-even sales revenue. So long as I have units, to convert this to revenue is really easy. So Roman 2, they want me to get revenue, break even, revenue, break even. So to get this revenue break even, we know that revenue equals PQ. So we start with A. We have the selling price of A. Oh yes, it is 10 for A and B is 8. So for A, I will take 10 times the quantity here for A, which is 76, 923.08. Which will end up giving me 76, 923, 0.8, like that. And then B, the selling price there is 8 times the quantity of B, which is 115, 384.62. Are you able to give me this answer now for boy? Is you're finishing, and then I give you some homework. You'll be having 2 questions to do tonight before you sleep. You must be more aggressive than your mwalimu. Let me tell you. You must be more aggressive than your mwalimu. Have you ever known that your mwalimu is very aggressive? Are you aware that I'm very aggressive? Are you aware that this mwalimu is very aggressive? You'll be surprised, yes. So the total, please add the 2. Yeah, add the 2 to get the total. Revenue break even, 92,307, 6.91. So now I want the total. I want the total now. I want the total. I want the total. Please add the 2 to give us revenue break even before we break. 169, 2, 307.7, whatever one. 169, 230. Yeah, thank you very much. But now you see, ladies and gentlemen, as you disappear, we have this other method where we said method 2. Oh yes, you can come and get revenue break even directly, which will be fixed cost over CMR for a single product. But you see, if it is multiple products, we talk of WAR, weighted average contribution margin ratio. Yeah. So this is weighted average contribution margin ratio. That is what we call WACMR, like that. If you can know how to calculate this tonight, I should be able to give you a present. What do you think shall you do to get this WACMR? Anybody who can give us a formula? What do you think shall we do to get this WACMR? As we disappear, please. As we disappear, please. I should be able to give somebody a present today. There's not a single class that goes like that without Mwalimu giving a present. Without Mwalimu giving a present. Anybody who could just try the formula for getting the WACMR. Thank you so much. These are great ninjas. They have known that WACMR equals, you see, generally CMR is CM over P. But you see now we have weighted. So you should be able to give us WACM over WAP. WACM over WAP. So WACM, remember WAP is weighted average price, which we got already. Weighted average price. So the WACM, already we have WACM. WACM is 5.2 and the WAP is 8.8. Already we have that. So this is 5.2 over 8.8. Please give me 4 decimal places, please. Kenneth, if you do it that way, that is normally something that the examiner wants. If you use this concept of weight times CMR, you will be so wrong. Thank you for trying, but it will be so wrong. Okay, so I'm being given 0.5909. Thank you so much. We'll come back to this formula. The fixed cost remains 1 million. All over the WACMR that you have. All over 0.5909, which then will end up giving me what figure? Please, just help me, please. Help me. Please help me. Please help me. Are we getting an answer that is very close to what we got using the other method? May not be exact because of rounding off errors. It's just somebody who is getting an answer that is very close to this. Very close. They have learned something. A homework that has to be done tonight. And I will start looking at your group from today. A homework that must be done tonight is question number 4. Now you'll be able to address this very well as I come to the end of this CVP subtopic. Question number 4. Question number 4 of December 2024. Question number 4, December 2024. Let me know when you are able to finish this in the next 1 hour or so. Otherwise, ladies and gentlemen, it has been a pleasure. It has been indeed. Otherwise, ladies and gentlemen, it has been a pleasure really hosting all of you. I'm looking forward to meeting you in our tomorrow's sessions. Keep it at RCM. Continue marketing RCM always until we become a university. When we become a university, we'll be able to get bigger visibility outside here. Not finished writing. Sorry. Yeah, at times I talk very fast. So I don't know whether you could take a screenshot. Or you tell me to move to, yeah, good night. Goodbye. Gadoni, have you gotten the present? I doubt. Have you gotten the present, Gadoni? No. We'll get it tomorrow. December 2024, question number 4. Wonderful. Thank you so much, Mercy. We shall overcome, yeah. December, the question, December 2024, question number 4. Please do it tonight. I don't want you to struggle with this at the very end. I want us to get everything right. Done. Thank you so much. Have a lovely night. Let me also hop into my next class known as Artificial Intelligence for Accountants and Auditors.